Welcome to the Food Startups Podcast.
Hey guys, this is our 44th episode. I'm coming to you live from Cartagena, where I'm working on a container shipment that will leave the port in about a week. Now, I think you guys should be aware of something if you're ever getting involved to importing or exporting containers. That's very, very important for at least US and Europe. And it comes down to the wood. Making sure the wood is good. What do I mean by that? In the container, for the pallets or any type of structures you use for dunnage, which is to hold up the pallets and make sure nothing spills all over, the wood must meet all of the standards of the country you are entering. It's really important because the stink bug got introduced into a port on the East Coast. It was in a wood pallet that came from China. Now, if your wood does not comply, you have to ship the whole container back to wherever it came from. So it's very, very important to be on top of this. Today, we are going to go into something very, very interesting, and it comes down to a question that a lot of times any entrepreneur gets asked. They're going to say, how is business going? A lot of times we'll give a generic answer. It's good. It may be good. Sometimes, you just don't know what you want to say. Sometimes you're just not sure. Sometimes you don't feel like getting into all the specifics. Sometimes you don't think the other person really wants to know all the specifics of your business. But for those times when you're not sure, a big factor in that can be your financial health. What are the key factors to financial health? Our guest today, Joe, has worked with Fortune 500 companies, and he's found that some of these top financial people don't have the answer. So he's going to help explain to us as food startups the key financial metrics that we need to be aware of when we are starting our food business and as we continue to grow to help us make better decisions and have better financial health and success with our business. Joe Knight is coming on today. He is the co-founder of the Business Literary Institute. I found him because I read his book, Financial Intelligence for Entrepreneurs. And he has so much experience. He's got a manufacturing company where he developed a lot of these strategies called Setpoint, and they do things for Tesla and other big companies. As a consultant, he trains managers and leaders at Fortune 500 companies like NBC News, Granite Construction, General Electric, Electronic Arts. There's so much to learn today, so I'm going to bring him in right now. Well, Joe, thank you so much for coming on to the show today. I really wanted to start off with how did you come to the conclusion that financial literacy should be required of everyone inside a company?
Really, the way I started with this is in my own manufacturing company. At Setpoint Systems, we build automation equipment that's used to produce other products. For example, we build machines that load the batteries for Tesla automobiles. We do a lot of work in the airbag industry, and we also have done automation in the amusement industry. So in that business, we have a lot of projects, and it's a very complex business, and we found out, like most businesses, it's hard to make money. When I got involved early in my career with the two founders of this company and became a partner, we decided that the way to run the company and to be successful is to open the books and share the information with all of our employees, because we wanted them to know what was happening in the business and have them understand, the ups and the downs of the business so they could help us work our way through it. And after we started sharing the numbers, we found that people worked differently and were very motivated and did a great job. But one of the things that was missing was understanding. We would show numbers at the end of every month, and even my partners who are engineers didn't understand how to read a balance sheet. They didn't understand a lot of the key metrics that we were tracking. I realized right then that a lot of the employees in my business and my partners did not understand finance. They didn't understand the statements, the metrics, and the numbers that go into measuring financial success in a business. So in talking with my partners, we decided that I needed to develop some modules that would teach our employees on how to read the statements. For example, we did a little module on the income statement and why profit is important. We did a module on the balance sheet and what to look for. We also taught about cash flow. And as I taught the classes, I kind of got together and figured out a system that made sense for my employees and for my partners in understanding finance. Several years into this, after the business was thriving and growing, and we were really committed to this philosophy of keeping numbers in front of everybody, a lady named Karen Berman, who has a PhD in educational psychology, was looking for a partner that had a finance background because she wanted to implement what she had studied in academia and what her doctoral thesis was based on, and that was research that when employees understand the finances in a business and what they mean, the businesses tend to perform better. She met me at a conference. We collaborated. I shared my material with her. She had her own material. We put together our own system and built a business called the Business Literacy Institute. And it turned out that most of our clients were large Fortune 500 companies. And we grew the business around that. And as we were training, we got a lot of people asking the question, where can we get a book that teaches the way you guys teach finance? And we never were able to come up with a good answer for that. Well, finally, we decided to write our own book. And that book is a book that you mentioned earlier called Financial Intelligence. It's become a bestseller for Harvard. We just came out with a revised edition. We have a version for entrepreneurs, IT professionals, and HR professionals. The graphic novel, as you mentioned, is pretty popular too, but the original revised version of the book still sells very well and is very popular. The reason why it's selling well and is very popular is because what we've learned, and this gets back to your question, kind of a long answer, what we've learned is financial literacy isn't just required in my small company, it's required in every company. In fact, now to large companies, for example, GE, they read the book at their Crotonville training facility. And they said, we need to find the people who wrote this book because we like this methodology. And so they called up my partner and said, we'd love to have Joe come in and do training and teach these concepts to our executives. But unfortunately, we're GE and our executives are very financially astute already. And so we would like him to teach a higher level finance course. We all assume that everybody knows finance. Well, the truth is they don't. And so several years ago, my partner and I, Karen, developed a test, a true-false multiple choice test with 21 questions. And we did a national study. We focused on large companies at the executive level, and the average score on that test in the United States was 38%. This was scored by an independent university. We actually published those results in Harvard Business Review in October of 2009 in an article, if anybody's interested in looking that up. But what we proved from that is that everyone needs financial literacy training. We all assume that everybody knows what some of those key metrics are and what they mean and why they are important. That is just not true. And so what we do now, when we get an executive that says, hey, our people are already at a higher level, we have them take the test as a group. And no executive team has scored higher than 59% on that test, even some with strong finance backgrounds. So what we set out to do, simply, Matt, is to bring financial literacy at a very basic level so everyone's on the same level. Everybody knows what key metrics are and what they mean.
Well, that's really eye-opening because I would have, when you were telling how you trained, top C-level professionals, that, I thought you were about to say that it was a more advanced program. So nobody above 59%. That's
as a
incredible.
group, exactly. You get one or two outliers who'll get in the 80s and even 90s.
Can you give me a specific example, either within Setpoint or, a company that you've consulted for, where someone, not from the finance team has made, I should say, a financial literacy decision that's really improved the bottom line for a company?
I could tell you a lot, but I'll just pick this one. We build automation equipment. So we have a lot of engineers and we have a lot of mechanical and electrical technicians that put these technical machines together. Well, what we learned as we tracked our numbers every week was the way that we make money in our project-based manufacturing business is by measuring our gross profit we generate per direct hour charged to a project based on the metrics we use, and what percentage of our labor is on projects rather than on overhead. So for example, if we have a high percentage direct and we're on very good, high gross profit generating projects, we always make money. And everybody in the team knows that every Monday when we put our numbers up on a whiteboard, that's how we track. Those two metrics are high enough, we're going to be in a bonus, a monthly bonus that we pay out and an annual bonus, which is much larger. And so everybody watches those metrics on a week-to-week basis. These two engineers, my partners, love riding motorcycles. And so they decided that they were going to develop, and this is many years ago, you'll know when I say this if you ride motorcycles, they wanted to develop an all-aluminum motocross motorcycle frame. This is in the mid-90s. And they said there's nothing like that, everything's too heavy, and we could build this really cool frame. And so they took 3 of their key engineers out of 10 employees in a company and put them on this special project. Just became a partner, I was a part-time financial advisor, and I'm saying, guys, that's 30% of your workforce, 3 out of 10, that is on an overhead project. If you take that out of your pool, you're not going to have enough direct hours to make money and get people in the bonus. It's going to be frustrating. It's going to be hard on the business. And they said, Joe, you don't understand. This frame is going to be so cool. It'll change the world. I call it if you build it, they will come mentality that engineers have. And so we'd have these debates back and forth. And I'd say, what about marketing? What about sales? Oh, no, it'll sell itself. So finally, they agreed to bring in one of their friends that they rode with, who was a Honda sales rep, regional sales rep in motocross. And he came in and we showed him the frame concept and all the ideas. And he looked at it and he said, what's your sales and marketing plan? And they gave him, if you build it, they will come. And he said, you guys know that there's Honda, Suzuki, Yamaha, Kawasaki, KTM. And he named all the manufacturers. And he said, if you try to sell a frame into that industry without any marketing, they will make sure no one ever hears about you. If you want to try to make this frame successful, you need to have a marketing plan, you need to be in the magazines, and you need to have someone racing. And said, okay, how much would that cost? And he said, about $3 million. So we're a 10-employee company startup, and exactly, we don't have $3 million. After he left, I looked at my partners and said, let's deal with the real truth here. You do not have $3 million, and we can't afford to take 30% of our labor force on something that won't pay us for years. And so the project was killed. And at that point, it was very hard on these two engineers because the frame was mostly built. We had a Honda engine. We were going to prototype inside of it, but the frame was taken off site. 2 years go by. I'm walking through the shop. Now we're about a 20-employee company. We've doubled in size. We're thriving. We're making money. And our best technician, Warren, who's been with us for all these years, he's working. He's running out of work. It's a Wednesday afternoon. He's run out of things to do. And again, it's all about how can we stay on direct projects and how can we make good gross profit per hour. And so Warren's thinking, I need to figure out something I can do more productive because I've run out of work on this Wednesday. So he goes to one of my partners and says, what can I do for the next 2 days that would be productive? And he said, all the parts of that frame are in my garage. I'm going to go get it at lunch and bring it back in here. And I want you to put that frame together because Warren was a great technician. And if he worked from Wednesday afternoon through Friday, he probably could have had the prototype ready. And my partner said, it just kills me. We never finished that project. And it kills me I never got to ride that bike because I think that frame is awesome, even if we never sell it. And so Warren said, well, you're the boss. Bring the frame in. And so the frame is brought in. And you know, the finance guy thinks, I think, what a disaster. This is such a waste of time and effort. It's such a bad sign for him to be working on that. So I walk up to Warren, not knowing the story, and I said, Warren, what are you doing? And he looked up at me and he said, I'll never forget this, Matt, because this was a great moment for me as a finance guy. He looked up at me and he said, Joe, I have no idea what I'm doing right now, but I can tell you one thing I know for sure. I am generating 0 gross profit per hour right now. And he looked at me frustrated. Now, why did Warren care? Because we track the numbers every week. And when he came to work, he wanted to generate gross profit per hour. And he knew that that was a metric that brought success to the business and also increased his bonus. That drives success in a business. When you have everybody focused on key numbers and key metrics and they understand them, your business will make more money.
Joe, I think most entrepreneurs may have, maybe not on such a large scale, will have some type of story like that where they just only thought about the product and they thought nothing about, let's say, the distribution. At least for my audience, I focus more on, financial intelligence for entrepreneurs and,
Sure.
the startup space. And so I want to go to a couple quotes from the book. First one I'd like you to address is the following. Quote, the 2 most important measures for the entrepreneur who is just starting out are cash flow and burn rate. In parentheses, the amount of cash you burn through to operate in a given period, usually a month. Now, can you explain these 2 terms just in case, because we're not all finance experts, as you know, to the audience, and why you believe this is so?
Sure, no problem at all. First of all, let me back up a little bit from that statement. If you run a small business, like I have for many years, at some point you contemplate going out of business. You have a tough few months, you go through a downturn and everything else. And I want any of you who are entrepreneurs to reflect on what scared you the most or why were you worried about going out of business. And without a doubt, you'll all think in your mind, it was the day I was wondering how I was going to make payroll. Well, the reason why you worry about making payroll is because you need cash to make payroll. So the first thing that we have to learn as an entrepreneur is that generating cash, which we call cash flow, we can interpret that differently when we get to the statements, but that's a whole other level. The first thing is to make sure we understand how cash flows into our business and how it flows out, intake and exhaust. As a small business owner, the first thing you have to have a handle on is how cash flows into your business and how it flows out of your business. The way cash flows out of your business is something that we like to call a burn rate. A burn rate is how much do we burn every month in terms of fixed expenses or expenses that don't go away. A lot of that will be your salaries, your rent, your utilities. What is the burn rate in the business? And then you have to contemplate how much cash you're generating through other means, hopefully by your revenue or your sales and how much you're collecting, to cover the burn rate with an excess on top of that. So that's kind of a simple definition of cash flow and burn rate. The first thing you have to do when you start a business, particularly in a business like the food industry where you have a lot of labor and you have a lot of food cost, is your burn rate versus your ability to generate revenue or cash to overcome that burn rate. If you are in a situation where you're not sure you can cover your burn rate day in and day out, that's going to be a miserable experience to try to run a business like that. I would recommend you step away. So that's the first thing you should look at.
Now, to clarify with the burn rate, you talk about, how much should we burn on fixed expenses? An expense could also be something like an investment in, new inventory or something like that. And that's not necessarily going to be the same price every month.
Buying inventory is a negative to cash flow. A lot of people, this is where people have a lot of problems with the statements. And the book describes this pretty clearly, but cash is not profit. Your accountant will take your revenue and subtract your expenses in any given period and say you're profitable. But if you take a lot of cash to, for example, buy a lot of inventory, or even worse, this isn't true in the food industry, but even worse, if you sell to a customer that's going to pay you in 60 days, and a lot of large companies pay that way, you're doing a lot of work and spending a lot of money today for revenue that you're counting, and you might even be showing it as profitable revenue, but it might take months to cover that inventory cash you put out, and it might take even another 2 months to collect the cash for the work you've already done. And that's true in the catering businesses as well in the food industry. So what you have to think about first before you get into your profit and loss statement that your accountant's going to help you with is your burn rate and your cash. And that includes a lot more than just the revenue that you sell and how much you collected and the salaries you have. It includes what we call working capital, which is inventory or receivables and other things like that you have to invest in your business as it grows. And the faster you grow, the more of those outside of the income statement cash flows will go out of your business. And you have to figure out how to measure that and track that, or you will run out of money.
Let's talk about, a really big purchasing decisions. We've gone through cash flow, we've gone through burn rate. We talked the fact, listeners, if you're selling, let's just say to Whole Foods, and maybe they pay net 30 or net 60, not only that, but the time it takes you to make the food and get it could be 4 to 5 months before that money you invest actually gets paid. So that's definitely something to think about. Let's say you're faced with a very big purchasing decision, a new piece of machinery, a quality control certification like HACCP. Are there any other financial metrics or rules of thumb that we can apply here?
Well, absolutely. I mean, if you're talking about big capital expenditures, you get into the area of capital budgeting or return on investment. Now, again, there's a section on that in the book. I just worked with HarvardHBR.org to develop an ROI toolkit, but there's a whole different area of finance. You use metrics such as net present value, internal rate of return, and payback to make sure that investment makes sense. Now, as a small business owner, you're going to have to understand the cash flow associated with payback, which really measures if I spend the money on that equipment for my business, how long will it take to get the cash back directly from that equipment to justify that investment? Because if you spend a lot of money on equipment, your cash is gone. So that equipment's got to generate cash for you.
And Joe covers all of these terms, in his book. But I'll link to all these terms that Joe mentioned here, and I'll put the definitions on the website.
Sure, absolutely.
Well, great. Well, we already touched on cash flow, and it just seems something that no matter how big or small your company is, you got to keep going back to cash flow, cash flow, cash flow. I have two other metrics I'd like you to explain to the audience: free cash flow and ROA, return on assets. Can you tell us how we measure these and how we can apply them?
Yeah, sure. First, free cash flow. I like to say, if you go back about 10 years from now, from where we are now, the most important metric for a small business is, and it's still very important, but the most important number in a small business is a number we call EBITDA. Now, EBITDA is actually an acronym. Some people used to tell me it's an obvious form of EBITDA, but that's not what it is. It is earnings before interest, taxes, depreciation, amortization. And a lot of people 10 years ago thought of that as a measure of your future cash flow. EBITDA is theoretical cash. It's not real cash. And so people start asking the question, where can we get a metric that measures the real discretionary cash that a business generates? There's two reasons why that was very appealing to large companies and small companies alike. One is with all the fraud that went on, you had the WorldComs and the Enrons and the Tyco stories and all these things going on with people who basically lied on their income statement to keep investors happy. What they realize is if you look at cash flow, that's a concrete number that we can audit immediately. And if you're generating cash, you'll survive anything. And so, one, looking at cash flow as a metric eliminates the estimates and assumptions inherent in an income statement or a profit and loss statement. And number two, even more important lately, is the fact that if you generate your own cash, you don't need to raise money from an outside investor. You don't need to raise money from a bank. You have your own cash flow. The definition of that cash flow is what is called free cash flow. Now, that's a Wall Street definition. It's actually a very simple number. And the origins of it come from Warren Buffett. Warren Buffett's a famous investor. A lot of you have probably heard of him. He's one of the most successful investors in the history of investing, maybe the most. And Warren Buffett, during the dot-com bubble, said, I don't like EBITDA because it doesn't give me a number of real cash flow. And everybody said, Mr. Buffett, it's an indication of cash flow. And that's what you really need in these small startups, especially the dot-com companies. The number that I need to get is I need to say, how much operating cash flow does this business generate? Now, operating cash flow comes directly from the cash flow statement. Okay, that's a number. Then he said, how much money does that business need to invest in new equipment for next year, new capital that you need? That comes off of the investing section of the cash flow statement. Buffett called it owner earnings or owner's grocery money. Wall Street simply calls that number free cash flow. And all free cash flow is the money that your operation generates, which is measured on the cash flow statement, minus the amount of new equipment or capital you spend every year to keep the business going. It's basically the discretionary cash your business generates. And what we know about free cash flow is if you have free cash flow, you can get through anything because you have discretionary cash to manage your business. The second metric you asked about is ROA, Matt. And ROA stands for return on assets. Simple number. All you do is you take your net income during the year and divide it by usually the average assets you had during the year. So you can either take your assets month by month and get an average, or you can take the assets at the end of the year on your balance sheet. And what it tells you is for every dollar I have invested in the business, sometimes this is also called the general ROI, return on investment, because the assets on a company's balance sheet represent the money that's tied up in the business. For every dollar you have in assets in the business, how much money did you make? And that's going to come out as a percentage. Some industries have return on assets of 5%, and that's considered a great number. On the other hand, a lot of high-tech companies might expect an ROI well over 10%. It depends on the industry that you're in and what your history is. Basically, return on assets is telling you what kind of return am I making on the money that I and my investors have put into the business in terms of assets.
Got it. Okay, great. Listen, Joe, I wanted to touch on something before I forget. The ROI toolkit, what you're doing with the Harvard Business Review, is this something we can buy? Is it an online tool? How can we get this?
It is an online tool. You go to hbr.org. Actually, a lot more detailed in my book on how you make an ROI model. And then it also has a couple of spreadsheets. It has a spreadsheet that shows an example of a equipment purchase ROI metric that you can actually download the spreadsheet and re-put numbers in. It also shows how we use ROI metrics to value a business. So those of you that are interested in looking at how you would value your business using what we call the discounted cash flow method, it has that in it as well, and it has a lot of explanations on all the terms in ROI we talked about. And it is something you can download through hbr.org, and they sell it that way. And that's another way to get at the material that's in my book with a little bit more detail, with some practical tools that you can actually use to apply to the things that you do in your businesses as you look at making capital investments, which is always a part of being in the food industry.
Great. And you're saying that is available now?
It's available now on hbr.org.
Great. Okay. I want to go into one more metric, Joe, your quick ratio. And the reason is something that lenders and vendors sometimes will look at in the food industry that can be very, very common. So I guess I want to know, explain the quick ratio and why do you usually want to have it over 1?
Sure. When you're running a small business, you want to focus on your current and your quick ratio. This is how it's calculated. I'm going to start with a current ratio. A current ratio is simply your current assets on your balance sheet. The definition of a current asset is any asset that you have that is currently cash or you expect to convert to cash within 1 year. That would include your receivables. For example, the stuff you provided to Whole Foods that they're going to pay you within 60 days, that's an account receivable. That's considered a current asset because you can convert it to cash within a year. Usually your inventory's in that. Any other assets that you expect to be able to sell or you'll collect on within a year. And then you divide that by what we call your current liabilities. A current liability on the balance sheet is simply any obligation that you will have to pay within 1 year. So for example, anything that you bought from a supplier or a vendor that you have to pay within 30 to 60 days would be called accounts payable, and it would be a liability on your current liability list in your balance sheet. You also might have a credit line, any kind of short-term debt. Anything that you owe within a year is going to be in your current liabilities. The current ratio is very simple. We take the total of our current assets and divide it by our current liabilities. So let's look at an example of the current ratio. Let's say if I add up all my current assets, which is all of the assets that I expect to convert to cash or already are cash within a year, and compare that to my current liabilities by taking current assets divided by current liabilities, and I get a number well below 1. Let's say it's 0.8. What that tells me is for every dollar that I can expect to collect or that I already have in cash this year, I'm only going to have 80 cents to cover the debt that I have to bring in. So if you have a current ratio below 1, that tells you that you're going to run out of cash and miss payroll. I like to tell people if you're going to a company that has a current ratio below 1, it's not going to be a good place to work because when people have trouble making payroll in a small business, morale goes way down. So you want to avoid a business with a current ratio at or below 1 because you're going to run out of cash during the year. So it's no surprise we call that the banker's ratio because bankers want to make sure you have a very positive current ratio. Because if it's not positive, above 1 is what I mean by positive, you're not going to have cash to pay off any loan a banker might make to you. Now, in some industries, that's converted to what we call a quick ratio. And that would be true in some of the food businesses that you're all working in. The quick ratio is simply this. What if you had a major catastrophe and you had to liquidate quickly to get cash? Obviously, the cash you have on hand you could use for the crisis. You could usually collect or sell your receivables very quickly and other current assets. But your inventory might be a lot of raw materials that you can't sell right away. And so the quick ratio is simply taking your current assets minus inventory, because that's not the easiest to sell in an emergency, and dividing that by your current liabilities. And again, you want that to be above 1 if you're in a very precarious situation in your cash flow, because if anything goes wrong and you can't sell that inventory quickly, you want to have enough cash to get through a crisis or a problem. And that's what is called the quick ratio. Some people like to call it the acid test. In other words, if things went really bad, would you have enough cash to get through the next few months?
Great. I really want to thank you for coming on today and taking the time. I know you usually work with Fortune 500 companies, but take some time to help out some of the startups to get them in the right direction.
No problem. Glad to do it, Matt.
Hey guys, thanks so much for listening. And as always, if you have any questions or comments, find us online at foodstartupspodcast.com.